All right. Welcome, guys. Welcome, guys. I'm super excited to have every one of you on board Equity Special Training on the global financial market. This is the beginners course. This is where we're going to be learning the basic and fundamental things that are going to be the bedrock upon which we learn the more advanced things like risk management and strategy management and become professionals and expert traders. All right. So you're welcome one more time. My name is Tony George, and I'm going to be your anchor, your trainer, your friend, your mentor, and I'll lead you through all of the trainings and be there for you to answer every questions that you want to ask. All right. So let's quickly delve into what we have for today. All right, what are the things that we're expecting that we will be looking at in course of our training? This is a course content. So in this beginners course, we're going to be looking at what is Forex and CFDs. And we are going to also consider the asset classifications after we've been able to answer what Forex is and what CFDs also is. Then we're going to look at the asset classifications, the things that are being traded in the Forex market. Then we also talk a little about leverage, Forex charts, buy and sell, market sessions and trading time zones, base and code currencies, ask and bid prices, spread, lots and contract sizes, what is PEEP, what are the market orders and their types, and then finally support and what resistance. These are all the things that we will be considering on the beginner's course. All right. So I need you to grab your notes, grab your pen, and I need you to follow me keenly and jot down everything as we begin to expatiate all of these things on the course content. So let's quickly get to business. What is Forex? What is Forex? All right, the word Forex is actually coined from two words, foreign and exchange. All right, it's actually a global market that allows the exchange of one financial asset against another, one currency or commodity against another. All right, so basically, when we talk about Forex, we talk about that market that allows you to exchange one assets. When I mean asset, I mean an item or anything, any financial instrument that has market value, an item that has market value. All right. So something that has market value can be changed for another thing. It can be bought, it can be sold. All right. So that's what I mean by financial asset. All right. So the forex market is that market that allows every one person. So whether you're a medical doctor, whether you're an engineer, whether you're a pilot, or whatever thing you think you are, the forex market is open for everybody. You only need to get trained. You only need to know a little of how it works. All right, and then you are good to go. You can trade it. It's open for everybody. You can begin to exchange one financial asset for another at the exchange rates, and then you begin to enjoy some benefits from or some profits, so to say, from the exchange rates that you from the exchanges that you actually make. All right, so it goes beyond just one currency, and then it goes into also commodities against another. Then the concept of CFDs also comes in. Now, what are CFDs? CFDs is the acronym for contract for difference. Contract for differences. That is CFDs. Now, they are contracts that are entered into by a trader and a broker to pay the differences in the settlement prices. All right, guys. Now, this is very, very important, and I need you to also pay attention with this because you get this basic concept, then you will be able to answer a whole lot of questions that most people who miss this concept later in time ask. All right, so let's get back to it. CFDs are set of contracts. They are contracts entered into by a trader and a broker. It simply means that once you sign up an account to start trading the forex market, all right, you enter into a contract which we call CFD, contract for differences. As the name implies, contract for differences. The it is a contract to pay the differences in the settlement prices. So let's take for instance now that you bought rice from a broker at 1,000, all right? let's just use rice. Let's assume rice is being traded. So you bought a unit of rice from your broker at 1,000, and then the value of rice appreciated to 1,500. All right. Let's assume the rice appreciated to 1,500. Now, your broker is responsible for paying you the difference between your 1,000 to 1,500. And what's that difference? 500, of course. Now, imagine that this is for a unit of rice and you traded, let's say, 100 units of rice, all right, or 100 kg of rice. I don't know whichever, whatever way that rice is being measured. Some it could be in units, it could be in kilograms, all right. Now, imagine trading 100 kg or 100 units. Now, that is going to be 100 times 500. That's like 50,000 naira, and your broker is going to pay you, is going to settle you, all right, the differences in this price. Now, what if you saw rice, a kg of rice to be at 2,000? Let's assume a kg of rice to be at 2,000, and by your technical know-how, by your understanding of the market, you know that okay, rice is going to devalue. All right, the price of rice is going to devalue. Now, sorry, I made use of rice because the Japans who established the candlesticks traded more of rice and futures. All right, so rice just came in and I had to use rice. Right, well, let's just use it to understand these concepts. So you are trading, you saw that rice is a kg of rice is at 2,000, and by your technical know-how and understanding of the market, which after now you're going to learn all of that, you know that the value of rice is going to depreciate, all right, below 2,000. What you simply do is what you simply sell, saying that this is going to what depreciate. So if it depreciates to, let's say, 1,500, 1,500. Your broker is going to pay you the differences in these, from when you took an order to sell rice to where the value of rice currently is, which is what? Still 500. So whenever we talk about CFDs, we simply talk about that contract entered into by a trader and a broker to pay the differences in the settlement prices. All right. Now that is how simple and how easy this could be. All right. Let's quickly run to the next slide and then we will explain it the more. Now let's think of an asset, say gold. All right. Let's just say gold. Okay, gold is very widely used and popular. All right. So let's say gold. Now we have two scenarios. First, let me say this, that the foreign exchange market, which is a forex market, is not like our traditional market where we buy an asset and hold that asset for it to appreciate before we sell off. No. Now, because of the contract for difference, we're not limited by a one-way movement, which is only buy low and sell high. We are also able to benefit or profit from the market when the prices also depreciate. So it's a simple technique. When prices are about to appreciate, we do what? We buy. So buy, once you say buy, what your broker understands is that you are saying that prices are going to do what? Appreciate. All right. Understand this concept, please. Once you say buy, because we have two options, either to buy or sell any asset, any commodity, any shares, any stock. All right. Now, once you say buy this share or buy this stock or buy this currency, what your broker understands is what? That the value of that asset you're saying buy is going to what? Appreciate. And if it does appreciate based on your analysis and understanding of the market, your broker pays you the difference from where you enter the market to say buy to where it has actually appreciated to. All right. And if you notice that based on your technical analysis that the price of a particular asset or financial instrument is going to fall or depreciate, what you simply just do is say sell. So once you click on sell, your broker understands that what the value of that asset is going to what depreciate. All right. Now, this is a simple technique. So now let's come back to what we see on the screen now. Now, we saw gold at $1. And based on our technical analysis, let's assume we knew gold was going to appreciate. What we basically do is what? Buy. We just hit the buy icon or the buy button, Boom. Once you hit the buy button, you have actually placed an order that you want to buy gold at $1. So if gold appreciates, you're going to make profit because you said what? Buy. Now let's assume gold have actually appreciated to $5. Now there is a price appreciation of $4, right? That is from $1, it moves to $5. Now that's the difference between $1 and $5 is what? $4. Now imagine that you have actually traded 10 units or 10 ounces of gold. All right. Now, for every ounce you made $4. For 10 ounces, you're going to make about what? $40. It's very simple. This is no magic. All right. And then also, let's say you sell gold at $10. You knew by your technical analysis or by your technical know-how that gold was going to fall below $10. Now you saw it at $10. Once you click the button sell, boom, you have already automatically told your broker that what the value of gold is going to be depreciated. It simply means it's going to sell. All right. So once you hit the icon, what your broker understands is that, okay, this asset is going to do what? Sell. It's going to depreciate. All right. Now, gold fell from $10 to $8.50. I am assuming this. Don't get lost. I'm assuming this. All right. It fell from $10 to $8.50. All right. Now you notice that there is a price depreciation of what? $1.50. That's the difference between where you sold and where it has actually moved to. Now imagine that you have sold 10 units or 10 ounces of gold. That will amount to what? $15. And your broker is going to pay you this $15 because it's a what? Contract for differences. Your broker pays you the differences in the settlement price, or you pay your broker the differences in the settlement price should your analysis go bad. All right, should your analysis go the other way, let me put it that way. All right, let's quickly continue. So basically, having known this now, we will quickly delve into knowing what are those assets, what are those instruments, what are those financial assets that I keep talking about, what are they that are being traded on on the forex market. First, we will start with what we call the currency assets. There are actually five large markets. I'm going to touch them briefly. All right. So let's start with the currency asset. Now, the currencies are traded only in pairs. That is buying one currency against the other. All right. So you cannot actually trade one currency alone in itself. For instance, you want to trade euro. You cannot trade euro alone in itself. Euro has to be paired with another currency. Say maybe euro has to be paired with Great Britain pound, or probably euro has to be paired with the United States dollar, all right, before it can be traded. So one currency or one asset alone in itself cannot be traded. It has to be first what? Paired before it can be traded. Now, before we will go into the pairing and why they are paired that way, let us look at 8 major currencies that will help us understand why they are grouped or paired in certain class, why they are being grouped in certain classes. All right. So what are those 8 major currencies? We will quickly delve into that. Like, yeah, we have the United States dollar, all right? The symbol is the USD, and then of course it has the nickname which is popular as buck or greenback. Then we have the euro, which is the EUR. It is popularly known as the fiber. We have the Great Britain pound, which is the GBP, popularly known as sterling or cable, all right? Then we have the Japanese yen, the JPY, which is yen, all right? The Swiss franc, which is CHF, all right, the nickname is Swizzy. Then we have the Canadian dollar CAD, which is Loonie. We have the Australian dollar AUD, which is Aussie. We have the New Zealand dollar NZD, all right, which is what considered Kiwi. Now, it is good that you go back and also try to see how all of these can be at your fingertips, because most times you could be around some professional traders and they call these currencies by their nicknames, not by their original names or symbols. All right. For instance, somebody who want to call dollar and he would say buck. All right. You need to understand that buck is USD. Or somebody say kiwi. You need to understand that kiwi is what? NZD. Or somebody says loony. All right. Let us trade buck loony. Or let us trade um, kiwi loony. All right. Sometimes they could just call it anyway. So that's why that you just have to have it at your fingertips. But that's by the way. Now, these are the eight major currencies that you need to understand. Why are the eight major currencies? If you notice very well, they are currencies of the eight major economies or well-thriving economies currently in the world. All right, so they form the eight major currencies. Now, once you understand this, we will quickly go into the classifications of how these currencies are being paid. All right. Now we have three major categories or three major groupings of currency pairs. We have the major pairs, like we have here on this column. We have the minor or the cross pairs, and then we have what the exotic pairs. Now, the major pairs, I'll quickly show you that. All right. I need you to write this down now. The major pair is the major currencies being paired with the United States dollar. Now, I gave you eight major currencies, right? I gave you eight major currencies: one, two, three, four, five, six, seven, eight. Now, these eight major currencies, if they individually are being paired with the United States dollar, they form what we call the major what currency pair. So we can have the Euro USD, we can have GBP USD, we can have USD JPY, we can have USD CHF, we can have CAD USD, we can have AUD USD, and then we can have NZD USD. All of them individually being paired with the United States dollar forms what we call what the major currency what pairs, the major currency pairs, and that is what we have here: Euro USD, GBP USD, NZD USD, AUD USD, and so on. Now we talk about the minor or the cross pairs. The minor or the cross pairs are the major currencies being paired with themselves but not with the United States dollar. I'll take that again. The minor or the cross pairs are the minor currencies being paired with themselves but not with the United States dollar. And so you're going to see things like the euro crosses, where we have the euro GBP, euro JPY, euro CHF, euro CAD, euro AUD, and euro NZD. And then we can also have the GBP crosses, which is GBP JPY, GBP CHF, GBP CAD, GBP AUD, GBP NZD. Now, if you notice very well, I have been able to call out euro crosses and GBP crosses, but without having to pair with the United States dollar, right? Now, these are called what? Minor or cross pairs. We can also have some other crosses like CAD JPY, that is Canadian dollar, paired up with the Japanese yen. Or we can also have the AUD card, that is the Australian dollar, being paired with the Canadian what? Dollar. All right. So let's quickly look at that. That is where we have Euro GBP, NZD JPY, GBP JPY, and so on and so forth. Quickly, then we talk about the exotic pairs. We talk about the exotic pairs. What are the exotic pairs? The exotic pairs basically are the major currency pairs paired with any other country's currency, or any other country that you probably may think of that I haven't mentioned among the eight major currencies. If they pair up with the eight major currencies, we have what we call the what? Exotic pairs. And that's why we have the Euro NGN, which is of course the Nigerian Naira, and then we have the Euro TRY, the Turkish Lira. Then we have the USD HKD, that is United States dollar paired with Hong Kong dollar, USD SGD, that is United States dollar paired with Singaporean dollar, USD HUF, Hungarian forint, USD MXN, that's the United States dollar paired with the Mexican pesos, and then we have the USD ZAR, South African rand. Now, if you notice very well, a new set of currencies were being introduced, but being paired with any of the major currencies like Euro or USD. All right, this forms what we call the exotic what? The exotic pairs. All right, so these are the classifications of currency pairs, and you can trade every one of them so long they are being listed on the broadcast platform. All right, so quickly let's look into more assets classifications that are being traded on the global financial market. The next is the crypto asset. Crypto assets are digital currencies that are also traded what? In pairs. All right, so the crypto assets are not also traded in themselves. So you cannot trade Bitcoin alone. You cannot trade Bitcoin Cash alone. They first have to be what? Paired before you can trade them. All right, so what are those crypto assets? On our platform on Equity, we have currently about four major cryptocurrencies that are being traded. Now, listen, a whole lot more, about 30 or more crypto assets will soon be launched on our platforms also. So you just stay tuned, and you will be updated when these crypto assets will also be launched on our platform. But for now, these four major ones are available for everyone to find opportunities and spot opportunities and make the most of them. So we have the Bitcoin, right? The symbol is BTC, but it's paired with the United States dollar. And then we have the Bitcoin Cash, all right, the BCH US dollar, Ethereum, which is ETH, of course we know, paired with the United States dollar. And then we have the Litecoin, LTC, paired with also what? The United States dollar. All right, quickly, we also consider the next assets that is being traded, which is the stocks or equities. Stocks or equities. Now, stocks are publicly traded, stocks or equities are publicly traded company shares like Adobe, Airbnb, Alibaba, Amazon, Apple, Berkshire Hathaway, Barclay, GlaxoSmith, Unilever, BMW. Mention them: Apple, Cisco. All of them. They are. We have the stocks of these companies on our platform. Very shortly, I'm going to be showing you all of these things I'm just talking here on the screen. I'm going to show you live on the trading platform so you also see it for yourself. All right. Now, all of the shares of these companies that I mentioned and even more are being traded on our platform. The beautiful thing is that on our platform, we have the UK shares, we have the US shares, and then we also have the European shares. All right, that's so amazing. That's so amazing. That simply gives you a whole load of opportunities, a whole lot that you can look into and spot opportunities from. The opportunities are just limitless. All right. Now, the next we're going to be looking at is the index assets. The index assets. Now, the index asset measures the price performance of a group of securities or assets using a standardized metric. All right, I'm going to explain that in a way, in a very simple way. You're going to understand. Now, let's look at this. Let's assume that this is a basket, and in this basket, we call it most times basket of securities or basket of assets. All right. So why we call it as a basket of assets or basket of securities is because it's many securities put together in one bag or put together in one basket, so to say. So let's assume this is an index company. All right, let's represent it in this circle. Now, what this index company does is that it has the shares of so many other companies in them. Let's assume that this is an index company here in Nigeria, and I don't. Let's assume that these index companies buy shares from, let's say, First Bank and UBA, Dangote, Dan Tata. Um, trying to think of Nigerian shares, Globalcom, and then MTN. Okay. What other companies are in Nigeria that are prominent and are doing really well? All right. Let's say Jais Bank. All right. Now, it mustn't just be banks and construction companies, but so many other companies. Let's also think of some pharmaceuticals. Okay, Unilever is also very present in Nigeria. So let's say Unilever, we also buy shares from Unilever, and so on and so forth. So we buy shares from so many other companies. Now you notice that this index company comprises of so many other shares that it had bought. All right. So when a trader decides to trade an index company, he trades the price performance of this group of securities all put together. You trade them at a go. All right. Most times, what happens is that you trade the average performance of all the shares put together, and sometimes you trade all of them put together at a go. All right. Now that is index assets. All right. So when we talk about index assets, this is exactly what we mean. All right. Now, what are some examples of these index assets? We have the Japanese 225, that is the Japanese price index. We also have the UK 100. We have the UT 100. The UT 100 is the popular Nasdaq, right? The UT 100 is the popular Nasdaq 100, right? Which is 100 influential companies, more of technological companies in the US, all right? So when you talk about the UT 100, we talk about Nasdaq 100, all right? So you want to trade more of technological companies and what they are doing, the impact they're having in the US economy, and then we talk about the Nasdaq 100, which is the UT 100. All right, very beautiful. And then we have the US 30. You probably must have heard of Dow Jones. Yeah, Dow Jones is the US 30. Yeah, I said Dow Jones. Dow Jones is the US 30. All right. So when you look for Dow Jones, you think of US 30, 30 companies that are put together in a basket, and then we're able to trade the price performance of these 30 company shares or stocks put together in one basket. And then we have the DE30, which is also called the German index. All right, so this is the German index DE30. All right, so all of these and even more are index assets that traders can find opportunities and make the most out of such markets. All right, the last we're talking about is the commodity assets. The commodity assets are mined or produced products, usually natural resources or agricultural what products. Now they can be coffee, cotton, cocoa, gold, or silver. All of these are also offered on the platform. All right, and they are all under commodity assets. All right, so we have coffee, cotton, cocoa, gold, silver. Now, gold is represented in the market as XAU, while silver is represented in the market as what? XAG. All right, so these are the five different assets that are being offered on the platform. Very quickly, I'm going to show you these assets on the platform, right? So let's quickly look at them. All right, so these are all the currencies, like I mentioned, all of them mixed up, both the major, minor, and the exotic pairs. So we see we have AUD card, which is what? AUD card minor, right? AUD CHF minor, and AUD Chinese, this is Chinese currency, that's exotic, right? Hong Kong dollar, that's exotic, all right? So if you go through, you see over 60 currency pairs that are being offered on the platform. And then we also have the crypto, like I said, I'm coming back to that. The crypto, we have the Bitcoin Cash, Ethereum, and Litecoin. All of these are also traded on the platform. And then when we talk about the commodities, all right, we talk about the commodities. I told you we have the coffee, the cotton, and then the cocoa. But all these are futures, all right, commodity futures, all right. So we have the equities, which is the shares that I talked about. This is the European shares. So on the European shares, you see a whole lot of European companies that are being listed. All right, the Adidas to Airbus to BMW to Bayer, a lot of them on the platform. Beautiful. And then we also have the UK shares and the US shares, just like I mentioned. The US shares, you see AIG, you see AMD, you see Airbnb, the Adobe, the Abercrombie, you see a lot of them. You see a lot of them. You see Baidu, Cisco, a lot of them, a lot. Facebook also, ExxonMobil, yeah, ExxonMobil, the oil and gas company in Nigeria, yes, they are also being traded on the platform. So the opportunities, it's limitless. The opportunities are limitless. Then we also have the oil. We have the UK oil, we have the US oil. All these are offered on our platform so you can trade. Not only that, the futures of these assets also, a future contract of these assets also are being offered on the platform. All right. So with time, you also get to know the difference between the future contract and the CFDs. All right. So basically, all these and more, you see the metals, you see the gold paired with the euro, and then we also have the platinum, yeah, the platinum, the gold, and also the silver. All right, so endless opportunities await you on this platform. Endless opportunities await you on this platform. Now let's get to the next thing. Most times, a lot of people do not really meet the financial requirement to want to trade this global financial opportunity. A lot of people don't have the financial capacity to meet the requirements that is required of the average trader, and that is why the broker comes in to give to traders what we call what leverage. So what exactly is leverage? Leverage is offered by brokers to maximize traders buying power by giving them the ability to deposit small funds and trade larger volumes. To deposit what? Small funds. Now, you deposit small funds, but because you are on leverage, you are able to trade larger what? Volumes. Now, they are usually presented in a ratio from 1 is to 50, 1 is to 100, 1 is to 200, pending on the broker. Yeah, pending on the broker, you can actually trade with all of this leverage. Now, let's quickly take a quick example so you understand the power of a leverage. All right. Now, let's assume that we have two traders. This is the first trader, and this is the second trader, Scolon. All right. Now, the first trader has a trading capital, let's say funded $5,000. All right. And then the second trader also funded the same $5,000. Now, the first trader took a leverage of 1 is to 100, while the second trader took a leverage of 1 is to 400. Remember, they funded the same amount of $5,000 each. All right, but they used different leverage. The first trader used 1 is to 100, the second trader used 1 is to 400. Now, this is what happens. The first trader using 1 is to 100 has a trading capital potential. He has a trading capital power, all right, of 500,000. How is that 500,000? Now, it's 500,000 because um, every of his $1, 1 is to 100 simply means every of his $1 from this $5,000 has $100 purchasing capacity in the market. And so $5,000 will be 5,000 multiplied by what? 100, right? Now that gives us what? 500,000, which this first trader has. So in total, his $5,000 gives him, because of the leverage of 1 is to 100, it gives him a purchasing capacity of $500,000. All right. It simply means that whatever thing $500,000 could trade in the global financial market, this first trader will be capable to trade them. All right. Now, the second trader, because he used a leverage of 1 is to 400, which simply means that every of his $1 from this $5,000 has a $400 purchasing capacity in the market. All right. It simply means that his $5,000 has a total of $2 million purchasing capacity in the market. Let's quickly look at that. So you see, that gives us what? 5,000 multiplied by what? 400. And that gives us what? $2 million. So you see that both of them have different purchasing capacity. They can actually trade different volumes. All right. Why? Because of the leverage that they took. All right. The first trader took 1 is to 100, a lower leverage compared to the second trader who took 1 is to what? 400. It simply means that, okay, let's say for instance, um, you need to have a minimum of $1 million in your trading as a purchasing capacity to trade gold. Let's assume that's an instance. All right, it's not actually true, but that's an instance. Now you need a minimum of $1 million to trade gold. It simply means that this first trader will not be able to trade gold. He will not be able to buy or sell and make the most out of the opportunities that he finds in gold. Why? Because his trading capacity, his trading capital potential is lower than the requirement to trade gold. All right, but this second trader will be able to trade gold. Why? Because he is above the requirements. All right, now this is what leverage can do for you. It helps you to maximize your trades and your buying power. All right, beautiful. So let's quickly look at the next things, and then we will have a wrap up. Please, if you have any question, pen down your question, and after watching this video, you can always reach to me and ask me your questions. All right. Now let's talk about forex charts. Charts are graphical representations of historical price movement of tradable assets in the market. I take that again. Charts are graphical representation of the historical price movement of tradable what assets in the market. So when we talk about the forex charts, we talk about um, a graphical representation that can show us where the prices of a particular asset is coming from and where it could possibly be going. All right. So long we could have the historical price movement. Okay, gold moved from $1 to $2 and then to $5, and then it depreciated back to $3 and then $3.5, and then it moved up again to $4. It came back to $1 and then it moved to $10. Now, so long we could have all of these informations over time, all right, presented on a graphical on a graph. Then we can say that that is what a forex graph, something that could show us the historical price movement of tradable assets in the market. All right, now charts are really important to traders because it's the only way we see what happens in the market and take decision whether to what buy or sell. Charts, that's why charts are important. So a trader trading without a chart is like it's like driving a car in the night without a headlight. All right, you're driving a car in the night. No, everywhere is dark, but you're driving the car without a headlight. Now, it can be really dangerous. Of course, you can attest to that. Now, charts are important because it's the way we traders we see what is happening in the market. We see where the prices is coming from and where it possibly is going, and then we make the best decision whether to buy that asset or whether to sell that what assets. Now, there are three types of forex charts that I'd like us to quickly look at. First is what the line chart. The line chart represents only the closing prices of each asset's trading session, connecting them all together using what lines. Now, line charts represents only closing prices of each asset. All right, so where the price of an asset closed for a particular session, a dot will be connected to that point, and then to the next closing price, and to the next closing price. By the time you're putting all of them together or using a line, you have a chart that looks like this. All right, this is what we call the line chart. Right. The next is the bar chart. The bar chart are made up of series of vertical lines, all right, especially looking like this. Now I'm going to show you these on the trading platform. All right, so we have the bar chart also, which looks like this, having the open, the low, the open, close, the high, and also what, the low. And then we have also the third, which is the candlestick chart. The candlestick chart shows four important informations about the market. Four very important informations about the market. Now, why a lot of traders use the candlestick is because it shows in much greater detail what happens in the market, what happens between the buyers and also what the sellers. Using these four important informations, which is the open price, the highest price, the lowest price, and also what, the closing price. All right, like, as much as we have been talking about buy and sell. All right, so we have the buyers in the market, we also have those people who sell off in the market. All right, so when the buyers are in control of the market, we have what we call the bullish candle. I'm going to explain that very shortly. All right, now this is the bullish candle, this is a buyer's candle. All right, and this is the bearish candle, or more or less we could call it what, the seller's candle. All right, and I'm going to come back to explain when I will talk about candlesticks charts majorly. All right, in the intermediate classes, I'm going to explain these, and we're going to learn a lot from the Japanese candlesticks. All right, so let us quickly look at the buy versus the sell. The buy versus the sell. All right. On the platform, like I have earlier mentioned, if you click on buy, what your broker understands is that prices are going to go up. Prices are going to appreciate. That is what it simply means. Right. Now, to buy means to go long. So when you say long gold, what it simply means is to buy gold. All right. And then when you say short gold or short Euro USD, what it simply means is sell Euro USD or sell gold. All right. And remember, like I said earlier, when I talked about CFDs, to sell, you only sell when you know that the prices are going to do what? Depreciate. That's how you make profit. If you sell when prices are appreciating, of course you're going to be making losses. Why? Because when you say sell, your broker understands that what your broker understands is that prices are going to go low. Prices are going to depreciate, right? And when you say buy, what your broker understands is that prices are going to what? Appreciate. If you buy when prices are depreciating, you make losses. All right. Now, that being established, let's quickly go through what we call the market sessions and trading time zone. Most times, a lot of people wonder, how is it possible that the forex market is open for 5 days of the week? All right, the forex market opens by our own time Sunday night, and then it doesn't close till Friday night. Now there is no market as such. All right, no traditional market as such. Every market closes, and then the forex market is opened 24 hours a day and 5 days a week. How is that possible? That is only made possible using the market sessions and trading time zones. All right, so by modification, we have four different market sessions and their time zones. All right. First, we have the Sydney session, we have the Tokyo session, the London, and then the New York. All right. Now, let's start with the Sydney session. By our own time, Sunday night, 10 p.m. All right. Currently, Sunday night, 10 p.m., the Sydney sessions pops open. Why? Because those people living in Sydney by our own time, 10 p.m. on Sunday night, they are already on Monday morning. They are going to work, their banks are open, their economy is opened. All right, so there is actually there is actually a foreign exchange opportunities, foreign exchange activities already going on in Sydney, and that's global. All right, so the forex market automatically pops open by our own time Sunday night 10 p.m., and then the Sydney session will run through that Sunday night 10 p.m. up until Monday morning 7 a.m. 7 a.m. on Monday morning before the Sydney's goes off. So as the Sydney are going to bed, already those in Tokyo are awake by our own time 2 a.m. They run the market concurrently with Sydney up until 11 a.m. or 10 a.m. All right. But before this Tokyo are going off, the Londons are awake and then they run the market concurrently with Tokyo 1 hour before Tokyo finally goes off. And then Londons will run the market from 9 a.m. down to 6 p.m. All right, down to 6 p.m. our time. That's same Monday. All right, so you see how the sessions overlap with each other. The Sydney is more like a marathon. Sydney, before they go off, they hand over to Tokyo, Tokyo hand over to London, and London's before they go off, they hand over to New York. All right, so New York are week from 2 p.m. our time, and then they run the market till 11 p.m., 10, 11 p.m. All right, but before the New York goes off, already Sydney are weak and takes over the market by Monday night, 10 p.m. Sydney runs the market till Tuesday. All right, this continues on Tuesday again till Tuesday night. All right, and then by Tuesday night, and then by Tuesday night, 10 p.m., Sydney takes over the market, runs till Wednesday. So this continues up until Friday night, 10, 11 p.m. Finally, the market comes to a final close because at that time, every economy goes up, goes off for weekend. Every economy observes the weekend, and so banks are not open. Economies, most of the economies, government parastatals, and all of the foreign exchange are closed. All right, so the market also closes. Now, one question I would like to answer before I leave market sessions and trading time zones is this. Many times I've had people ask me, sir, when is the best time to want to buy? When is the best time to trade? When is the best time of the day to trade? When do you think there is more liquidity or volatility, so to say, in the market that I can actually make the most opportunity, or the maximize the most opportunity out of the market? Now, most of the time we experience high volume or high liquidity during the period that the London session and the New York session overlaps. During the time the London session and the New York session run concurrently, there is usually high volumes of market movements. There is usually high volumes that are traded within this period. And so there is high liquidity. Markets are moving seamlessly, all right, because of the high volumes that are being traded within this period. Why, you would ask me, why is it within this period? That is because the biggest markets, the biggest stock exchange markets that we have, the biggest economies are the New York and the London. When I say New York now, I don't mean just mean you in New York. I mean the US session. When I mean New York, I mean the US session. All right. When I mean London, I mean the UK session, UK. All right. And um Tokyo, I mean the Japans, all right, the Asian, all right, the Tokyo and Sydney constitutes the Asian session, All right. Now, the biggest sessions or the biggest markets are found in the US and the UK sessions. That is where during this period are the times where a lot of traders, a lot of money is being invested into the market, so to say. All right. And so within this period, because of the large volumes that are being injected into the market experiences what high liquidity, and that such kind of periods are the times are considered one of the best times to trade during the day. All right. Now, this explains why the market is open for 24 hours a day and 5 days a week. Let's quickly look at what we call the base and the code currencies. The base and the code currencies. The code currency is the currency used to buy the base. Before I come into that, let me just quickly explain this to you using the picture that you can see here, right? Now we have Euro USD. Remember, it's a pair. We trade it in pairs. We have the Euro and the USD. Now, what is the base currency? What is the code currency? Now, the base currency is the first currency in the pair. So the euro automatically is the base currency, while the code currency is the second currency in the pair. It simply means that in this case, USD is the code currency. So what's the difference between a base and a code currency? Now, whenever we say buy euro USD or sell euro USD, we are not selling euro and USD. We are not buying euro and USD. What we are trading is simply this base currency. What we're trading is simply what? This base currency. So when I say buy euro USD, what you're buying is what? Euro. When I say sell euro USD, what you're selling is what? The euro. So what about the US dollar, you might want to ask, right? Which is the quote currency. Now, whenever you buy the base currency, whenever you say buy euro USD, you're buying the euro, right? Whenever you buy the base currency, the value of the base currency you're buying, you're paying this exact value in US dollar. This is what it means. And then when I say sell euro USD, of course you're selling euro, but you're going to be paid the value of the euro you're selling in the amounts of the United States dollar. So in other words, we can say that the code currency here, which is what the US dollar, is the currency used to buy the base currency. We use it to buy the base currency euro, and if the base currency is sold, then the trader is paid the value sold in the amounts of the what code currency, which is the USD. All right, guys. If you've got any question, um, pen down your questions and do well to reach me. I'm there to always answer all of your questions. Okay. So let's quickly talk about ask and bid prices. Ask and bid prices. Have you ever gone into a bank and then you're going to see their exchange board? Their exchange board, it looks something like this. Forgive me, I'm not too good in drawing. All right, it looks something like this. And then here you are going to see, they say we buy, right? And then here you're going to see um, we sell. All right. Now we buy, we sell, and then here you can now see the USD. You can see here, sorry, you can see here the GBP, Great Britain pound, and then they are going to list how much they want to buy from you, how much they want to sell to you, how much they want to buy GBP from you, how much you want to sell to you, and so on and so forth, with other assets that are being listed. Now, this is how the exchange rate board looks like, right? When you get into the bank, what this simply means that for United States dollar, this is the amount we want to buy from you, and this is the amount, if you want to buy from us, we would want to sell to you. Now, exactly the same thing is what we call the ask and the what? The bid prices. So for the banks, it is we buy and we what? We sell. The prices of how much we want to buy from you and how much we want to sell to you. All right. But when we come to Forex, we call it ask and what? Bid prices. So the ask price is the price at which a trader accepts to buy an asset. while the bid price is the price at which a trader accepts to what sell an asset. Now I'm going to make that easy for you. I'm going to make that really really easy for you now. So um this is we buy, and this is we sell. All right. So I'm going to explain this to you in this manner. All right. For banks, it is we buy, we sell. The bid price is the price your broker wants to buy any of these securities that are listed here. These securities, USD CHF, Euro USD, GBP USD, AUD USD. The bid price is the price your broker wants to buy these assets from you. All right. So at this bid price, what you a trader do is that you sell. That is why we said bid price is the price at which a trader accepts to sell an asset. All right. Then we sell simply talks about the price at which a trader accepts to buy an asset. Why? Because at the ask price, your broker wants to sell. So at this price, you do what? You buy that asset. All right. Now that's very pretty much easy. Now that is the we buy and we sell. And that is what we call the ask and the bid prices. But this leads us to another very important thing we would talk about, which is called the spread. All right. It leads to what we call a spread. So, what is a spread? A spread is simply the difference in pips between the ask price and the bid price. It's simply the difference in pips. Please, pardon me, let me put this. It's the difference in pips because I'll shortly talk about the pips. All right. So, what exactly is pips and why we talk about pips? I'll talk about it. Now, the spread is the difference in pips between the ask price and the bid price. All right. So we go back to use one of such examples that were there. This is Euro USD. This is, remember, the bid price. And remember, this is what the ask price, right? Now, if I want to find the spread, all right, for Euro USD, when this is the bid price and this is the ask price, it's simply this subtracted, sorry, the bid price subtracted from the ask price, and that will give us 1.17220 here minus 1.17206, and that will give us 0.00014. Now you take the significant figure as points. All right, so this invariably gives us what? 14 points. This invariably gives us what? 14 points. Yeah, 14 points. Now, what is this 14 points? Is that all for spread? Of course, no. Spread is more like um the small negligible commission that you pay your broker for making the market available to you. Let me give an example that is very common in Nigeria. You go to some markets and then you want to sell in that market. Every day you pay a certain amount of money. For some markets, the people who watch over the market or who take care of the market would want to demand 100 naira daily fee, right? Why? Because they make the market available for you. If the market were not there, there will probably not be buyers, all right, coming into that market, and you who is a seller would not have a place to meet these buyers. So because they make this market available to you, even if you make 50 million, it's none of their business. Even if you make 100 million, is none of their business. What they are most importantly concerned about is that 50 naira or 100 naira that you're going to pay them, which is what? Not bad, right? Beautiful. Now think of spread like that. All right, because the broker makes this market available to you. Without the effort of the broker, you would not have the opportunity to explore the many opportunities to make the most out of such kind of market. And so you pay what we call what? The spread. It is very small, it is very minute when you're trading, and you may probably not even notice it because we offer a raw spread. All right. Okay, so let's quickly talk more about some other concepts as regards our beginners course. Let's talk about the lots and contract sizes. The lots and contract sizes. Now, lots is the unit of measurements for assets that are traded in the forex market. Is the unit of what? Measurements, the unit of measurement. It's the unit of measurement. So when we want to measure the volume that is being traded in the market, we simply talk about what? Lot sizes. All right. Now, the three basic lots and their contract sizes are given below. So we have the first column, which is a lot type. We have the second column, which is the contract sizes. We have the third column, which is the lot sizes, and then we have the last column, which is the pip per dollar movement of these lot sizes. All right, so let's quickly look at the three types of lots that we have. We have the standard, we have the mini, and then we have the micro. That is a standard lot, the mini lot, and then the micro what? Lot sizes. All right, now for the standard lot, if you trade with a standard lot, one standard lot, it simply means that you are using a contract size of 100,000 units. What that simply means that if you say I'm buying gold, let's say let's use a currency pair, Euro USD. All right. Let's say I'm buying Euro USD with one standard lot. What that simply means that I'm trading 100,000 units or 100 by volume. I'm trading 100,000 units of Euro USD. All right. And if I'm trading with a mini lot size, um, I'm trading in a multiple of what? 10,000 units. And if I'm trading with a micro lot size, I'm trading in multiples of what? 1,000 units. All right. So let's start with the micro lots. Let's start with the micro lot. So your broker does not understand you when you say 1,000 contract sizes or 100,000 contract sizes. All right. So your broker does not understand you when you say 1,000 contract sizes or 10,000 contract sizes. What your broker understands is when you put this lot size that represents the contract size, then your broker perfectly understands you. So, for instance, you want to trade just 1,000 units of a particular asset. What you should give to your broker that he understands is 0.01. So, once you impute in 0.01, your broker understands, okay, you want to trade 1,000 units by volume of that particular asset. And if you impute in 0.03, what your broker understands is that you want to trade 3,000 units, all right, by volume of that particular what asset. Now listen, from 0.01 to 0.09, that is from 1,000 to 9,000 units, they are considered what? As micro contracts or micro lot sizes. All right, and then from zero point 0.1 we have what we call the mini lot size, because now you're trading in multiples of what? 10,000 units by volume. Okay, and then you go on. 0.09 simply means you want to trade 90,000 units. All right, now I'll come back to explain all of these and how it works. All right. And then if you trade one standard unit lot size, one standard lot size, it simply means you're trading 100,000 units. So your broker understands you when you put in one as as though you want to trade 100,000 what units of contract size. Now, what does this lot size actually do? What it actually does is that it helps you to maximize your trades. All right, it helps you to maximize the opportunities that you find in the market. So imagine someone who trades 10,000 units. Remember, I made an example earlier that gold appreciated from $1 to $5. All right, from $1 gold moved to $5. Okay, let's see. Okay, so this is $1. This is $1, and then gold moved to $5, right? Beautiful. Now, imagine that I traded only one unit. Imagine I traded only 1,000 units. Let's come here now. Imagine I traded only 1,000 units. That is, I use micro lots of 0.01. As gold moved from $1 to $5, it simply means I am going to get $4 per unit. So if I'm trading 1,000 units, that's $4,000. That's what? $4,000. I'm just making an instance, all right? Just understand the picture. Now, imagine a somebody has bigger money than me, all right? Let's say I'm trading this with a smaller funds, and then somebody is able to have very huge funds, and then it begins to trade with one standard lot. And then while I'm trading with, remember, this is 0.01. Remember, this is 0.01. Now, Imagine if somebody is trading with one standard lot, it simply means that for every price movement that I'm making $40,000, this person is making four times what? Four times 100,000. Four times 100 what? Thousand. Of course, that is what? 400,000. 400,000. 400,000. Now you can compare 400,000 to 4,000. Now, this is because we don't have the same trading capital, and so we cannot we cannot take the same amount or level of risk. All right. So what lot size does is to help you increase or maximize your the opportunity the opportunities that you find in the market. All right. So once you have lower account size, you stick to smaller lot size that fits your account. And if you have bigger funds and bigger trading capital, then you can actually move over to using some bigger funds. Now let's quickly look at the micro lot. Now, if you're using the micro lot, for every one pip movement, I'm still going to talk about the pip. For every one pip movement, you make 10 cents. All right. For every one pip movement, if you're using 0.01, you make what? 10 cents. If you're using 0.02, you make 20 cents. If you're using 0.03, you make 20, 30 cents. All right. Now, for every one pip movement, if you're using the mini lot, for every one pip movement, you make $1. For every one pip movement, you make $1. And if you're using the standard lot, for every one pip movement, you make what? $10. All right. For every one pip movement, you make $10. Right. So I'll quickly go to talk about the pip. All right. So I'm going to quickly talk about the PEEP so we understand what PEEP is, and you won't be lost again on when we talk about PEEP. All right. So let's quickly talk about what PEEPs are. PEEP is the smallest movement of prices in the assets that are being traded. PEEP is the smallest movement of what? Prices in the assets that are being traded. Now, PIP is simply percentage and points. It is a fourth decimal digit in the exchange rates and the second in currencies that are paired with the JPY. So, currencies that are paired with the JPY sometimes are exceptional because they have exchange rates that have decimal places of only three, and while the rest have what? Decimal places of up to five, right? So let's take for instance in the pictures that are here, we have the Euro USD, and then what this means, 1.17206, it simply means that 1 euro is exchanged for 1.17206 what? USD. And what this means, GBP JPY equal to 150.654, it simply means that 1 Great Britain pound is exchanged for 150.654 Japanese yen. All right. Now, when we talk about the PEEP movement, this is exactly what I mean. All right, so when I talk about the PEEP movements, this is exactly what I mean. Now, let's assume that this is how an asset keep appreciating. All right, it keep moving from one price level, it got to this price level, and then it depreciated back to this price level, and then appreciated again to this price level. I don't want to give numbers to this, but I need you to just understand this so we can move from this level. It appreciated to this level and fell back to this level and then appreciated to this level. Now it keeps going up and coming down, exactly how prices of an asset moves in the forex market. All right. Now this is how it works. This is how it works, guys. All right. So if the market moved from one, let's say to price level two, we said that it had moved what? Say 1 pip. All right. Now I'm going to explain this more using the charts. Now, if it moves to three from one, we say it has moved what? 2 pips. If it moved from 1 down to 6, from 1 to 6, we say it has moved what? 5 pips. Now, pips is that smallest movements of prices in the assets that what you are trading. Is the smallest movement of prices in the assets that what you are what trading. All right. So I'm going to quickly show us that in just a few minutes. All right. How do we calculate pips in spread? How do we calculate pips in spread? Remember, we calculated spread earlier. We said that the spread is what? The ask price minus the bid price. And then we got 14 points. Remember, now I'm using GBP JPY in this example now. Now, what I need you to understand is that 10 points makes one pip. All right, 10 points make one pip. Why? Because remember, we have this last number as the point. All right. So 4 is the point, and the point is the negligible digit that we can do without it. All right. So we have the point, and then we have the peep. We have the point, and then we have the what? The peep. So this is more important to us. So 10 points here makes what? One peep. So this 6 moves to 7, it moves to 8, it moves to 9. As it gets to 10, yeah, the peep changes from 0 to 1, and here continues to move. All right, so 10 points what make one pip. All right, so if we're calculating GBP JPY, the spread in GBP JPY, remember this is the bid price, this is the ask price, then the spread in GBP JPY would be what? Ask minus the bid. So that would be 150.682 minus the bid, which is 150.654, and that gives us 0.028. But remember, I said take the significant figure as a point, especially that you are able to understand that the figures that you use, the exchange rates that you use, were having the points. That is this last digits 4 and 2. Then you can take the significant figures that you have as a point. So this gives us what? 28 what? Points. All right. Now recall that we have earlier established that 10 points make one pip, right? We earlier established that 10 points what? Make one pip. So it simply means that 28 points will give us what? 28 divided by 10. Of course, cross multiplication, 28 multiplied by 1 divided by 10, right? That's cross multiplication, right? I know you can still remember that. So this is 28 multiplied by 1 and then divided by 10 to give us 2.8 pips. So let's quickly do that now and see for ourselves. All right. So we have 28 multiplied by 1, right? And then divided by what? 10. That gives us what? 2.8 pips. So that is how we come about the 2 points what? 2.8 pips. All right, very beautiful. So let's quickly also look at pips to dollar calculation. Pips to dollar calculation, because in forex we don't talk about um we don't mention how much in dollars we're in profit, all right, or we're in loss. All right, what we basically we love to talk about is how many pips are you in profit, or how many pips are you in what? In loss. And so pips is more like our our money that we talks about in the forex market. And so the pips is what is being converted to the dollar. All right, just like I made mention of, just like I gave some examples when we talked about the loss and the contract sizes. Now let's see how it works and plays out here. All right, now for you to convert pips in profit or in loss to dollar value, use the formula below. So for you to get the amount in dollars, multiply the pips in points. Don't not the pips, not pips. Now the pips, the convert it to points, right? So the pips in points being multiplied by the lot size that you're using will give you the amount in what? In dollars. Let's take for instance to find the amount in dollars for 25 points using one standard lot, all right, that will give us amount equal to what? The pips in points. How many points do we have here? 25 points, right? If you multiply that with the lot size, what's the lot size? One standard lot. That is 25 points times one standard lot. That will give us what? $25. All right. So once you can multiply the points, multiply the points with the lot size you're trading with, then you can always get the value of the pips or the points in the amount of dollars. Let's quickly go back. Let's do something. So yeah, we're using 20. 28 points, right? So let's assume this is a spread. This is what you pay a spread for trading GBP JPY. Now, if you're using the smallest micro lot, which is 0.01, you're using 0.01, what it means is this. What it means is this, that you're going to pay 28 points, right? 28 points multiplied by the lot size, which is 0.01, and this gives us the commission. So in other words, you're paying 28 cents, 28 cents for trading 1,000 units of GBP JPY. So you can see that that is actually really small, right? Beautiful. So we have come to some more important, some other things that are also very important when we talk about the forex market. That is the forex what orders. The forex what orders. Now, I need you to put on your seatbelt again. I need you to pay a little more attention because we are here at some more important things again on the forex market. Now, forex orders are commands or buy. Their orders are commands to buy or sell certain assets in the forex market. There are basically two types of orders, which is the market execution and the pending orders. The market execution and what? The pending orders. I'm going to explain these to us. So I need you to just sit tight, pay more attention, um, so you will understand this concept. Okay? There are two types of orders, the market execution and the pending orders. All right. Now, what is a market execution? This is an order to buy or sell an asset with the current market price. It is an order to buy or sell an asset with what? The current market price. This type of order executes trades instantly at any price quoted for the assets what traded. So let me give you a perfect example. For instance, you walk into a shopping mall and you say you want to get a bottle of water. All right. Let's assume the bottle of water is 100 naira, and you bring in your 100 naira, you deposit your 100 naira, and then they give you a receipt for your payment. You walk away with that bottle of water and your receipt. What you have actually done is what we call market execution. Why? Because you bought that bottle water at the current market price. Okay, what if some hours later you go back into the same shopping mall and then you want to buy that same bottle water, but they tell you it's no longer 100 naira, it's now 120. All right, 120 naira. Of course, you consider it okay. Oh, 100, it's not much, and then you deposit in your 120 naira. They give you the bottle water and your receipt. You walk away. What you have actually done again is market execution. That is, you have bought that bottle water at the current market price. All right. And then also, for instance, you take your assets to the market to sell. Of course, let's assume you go with your bottle water as well to sell to somebody. All right. And then when you go to the market, you had the mind of selling it at 120 naira, all right, per bottle water. But when you got there, a lot of people were there also selling the same bottle water at 100 naira. And so that was like the market price, all right. So for you not to lose out, you decided to sell your bottle water at the current market price of 100 naira instead of the 120 you had in mind. What you have actually done is that you've carried out the market execution. You sold your product or your asset at the current what market price. Now, this type of order executes trades instantly at a price that is quoted for the asset traded. Before I will come to explain more of pending orders, let me give you a little explanation of it. As the name implies, pending orders, they are orders that are pending until certain criteria or certain things are met before they are being what executed or carried out. So unlike the market execution that is being that trades are being or orders are being executed instantly at the current market price, whatever is the price you see in the market, your trades are being executed. For pending orders, it is not so. For pending orders, you want to buy when prices get to a certain point, not with the current market price. So let's give you a perfect example. Let's say you went to buy the same bottle water, and then they are telling you it's 90 naira, and you'll be like, no, I've been buying this bottle water for 120 naira. Are you sure that this bottle water is 90 naira? Okay, I don't want to buy it at 90 naira. I'm lodging in 120 naira. All right, hold my 120 naira until whenever the bottled water comes to 120 naira, you call me, I'll come and pick it up. All right, it sounds foolish, but I'm just using it to cite an instance for you. Now, what you have actually done is that you have placed an order, but it's a pending order, and that pending order, it is until a certain criteria must be met before it can be executed. And what is that criteria? That until the bottled water comes to 120 naira before your order can be what? Executed, right? Beautiful. Now, before we come to main the pending orders and explain it in full and also look at the different types of pending orders, let us quickly look at some other types of orders that we have in the forex market and are also very important. The number one we're going to be talking about is the take profit order. The take profit what? Order. Now, it is an order to specify the exact rate to close out a certain position, buy or for what? For profit. Buy or sell for profit. Now, listen, when you open a trade, right? When you open a trade, right? Let's say this is gold, all right? Let's say this is gold, and then you bought gold here, let's say at $1, all right? Now, once you buy, you are saying prices are going to what? Appreciate, right? Remember, always remember that. Buy simply means prices are going to do what? Appreciate. Now, gold actually moved from 1 to 2, it came down to 1.8, and then moved over to 3, right? Until you close this order that you have placed, this buy order that you have placed, the order is not going to close. All right. Until you close this buy order that you have placed, the order is not going to what? It's not going to close. Okay, so this asset moves all of these way. You're from 1 to 2 to 3 to 4. Now, the farther it gets from when you enter the market, the bigger the profits that you make. So as it keeps going farther from your entry price, your profits keeps getting bigger. Why? Because remember, it's a contract for what? For difference. All right. If it moves, the more it moves farther and farther from 1, if it gets to 3, of course, you're going to be paid 2, which is the difference. If it gets to 10, of course, you're going to be paid 9, which is the difference. All right? 10 from 1, that's 9, right? Now, your trade is not going to be closed. It's a position that you opened. All right. It's not going to be closed until you close out that trade yourself. All right. Until you close out that trade yourself, your trade is not going to be closed. All right. So this is the idea. You should have a specific rate, a specific price level that you will tell yourself that I want to get out of the market with profits. All right. Now that's the take profit order. So what exactly is it? Let's assume you enter the market at 1. All right. You can say that I want to exit the market when it gets to 4. All right. So at price level 4, let's say this is price level 4. All right. Whenever the market gets to price level 4, automatically, whether you are there or not, the market is your position is going to be closed, all right, with profits. Remember, this is the price level you enter the market, price level 1, all right. This is price level 1. Now your take profit is price level 4. Why? Because you're buying, you're saying that the market will do what? Appreciates. All right. Now that is take profit what? Order. The stop loss order is an order to specify the exact rate, is an order to specify the exact rate to close out a certain what? Position, a certain position, buy or sell for what? For loss. All right. It's the price level that you want to you feel your analysis is being invalidated. You feel that the setup that you saw, it's no longer there. All right, it's no longer the setup. It's no longer what you expected from the market. It is best that you have what we call the stop loss order attached to your trade, so that as your trade or your analysis is being invalidated, it can knock you out of the market on a considerable loss than losing your whole account size. And that's why we have what we call the stop loss what order. That's why we have what we call the stop loss what order. So I'm going to quickly show you how the stop loss order works. Now remember, you've entered the market at one, price level one, for what? Buy. All right. Buy simply means the market is going to appreciate. If the market depreciates below price level one, of course, you are at loss. Why? Because you said the market was going to appreciate, but now based on the price movement, the market is depreciating below the price level that you entered the market. So if it gets to zero point 0.5, let's assume if it gets to zero point 0.5, of course, you are going to be losing zero point 0.5 per unit of that assets that you're going to be what trading. All right. So the stop loss order is good to be there, so that should in case the market goes against you, it goes below your entry price, of course, now it goes below your entry price. So should the market goes against you and move below one, all right, you have your stop loss order here. It's just like when you want to fall, all right? If in case you fall, should in case you fall, the stop loss order knocks you out on a considerable and well calculated what amount that you have calculated to risk. And then we have the trailing stop loss. This is how the trailing stop loss works. It is an order to stop the trailing loss that moves when the market movement is positive and stops when the movement is what? Negative. I'll just briefly explain that um, I'll briefly explain that to you so you understand what I mean by trailing stop loss. Beautiful. Now watch this. Remember, you entered a position here at price level one, all right, for what? For buy. Now, you can have your stop loss at zero point 0.5 because you're expecting prices to appreciate. So if price appreciates from 1 to 2, all right, and then to 3, once price appreciates to 3, what we call the trailing stop loss without you will automatically move to your entry price 1. So it simply means that if it moves to your entry price, should in case anything happens that this trade isn't able to get to your take profit level of 4, but begins to do what? Begins to come down. If it comes down, it is going to hit your trailing stop loss, which has automatically moved from what? 0.5 to 1. And of course, if the market hits you out on price level 1, you don't lose anything. Why? Because that's the level you enter the market. You've not made profit, you've not made loss. All right, except for the spread that you have paid. All right. Now, if the market has actually moved from 3 to 4, your trailing stop loss will move from 1 and place himself at price level 2. All right. So if the market gets to 4 and begins to come down back and hit your trailing stop loss at price level 3, all right, or price level 2, you still close your trade on what? Profits. Now, this is a simple technique, all right? But I would not want to confuse you, so I would leave it and explain it more when we get to the intermediate or advanced classes. But know that there we have the trailing what? The trailing stop loss. All right, we have the trailing stop loss. Okay, so let's quickly check out what we have next. The pending orders, yes. Remember, I talked about the pending orders. I talked about the different types of the pending orders that we have. So we have actually four types of pending orders. We have the buy stop order, we have the sell stop orders, we have the buy limit, and then we have the sell limit. Now, basically, these type of orders are classified into two: the stop orders and the what? The limit orders. All right. Let me just show you. Let me just show you that. Just show you that. So this is a pending order. Just a minute. This is a pending order, and from the pending order we have um, two types of orders, right? So from the pending orders we have the limit orders, all right, and we have the stop orders, okay, and from the limit orders we have the buy limit, right, and then we have the sell limit, okay. We have the buy limit and then the sell limit. And also for the stop orders, we have the buy stop and then we have the sell stop. All right. So this is how we have the pending orders. All right. So the pending orders are divided into limit orders and stop orders. For limit orders, we have two types of limit orders, which is the buy limit and the sell limit. And we also have two types of stop orders, which is the buy stop and what? The sell stop. All right. So basically, I'm going to be explaining these four: buy limit, sell limit, buy stop, sell stop. All right, as the different types of what? Pending orders that we do what? Have. Okay. Okay, so let's quickly go with the buy stop orders. Now, the buy stop orders, this is a deferred buying order. Remember, buy stop, sell stop, buy limit, sell limit, I have mentioned are pending orders. And I earlier explained that pending orders are what? Orders that are kept pending until certain criteria or certain things are met, all right? Until certain things are met. So when I talk about the buy stop order, I'm simply talking about a type of pending order, which is what? A deferred buying order. All right, it's a deferred buying order placed above the current market price. If the price rises to the other level, then it will be what? Executed. So, like I mentioned, let's assume this is the current market price, right? This is the current market price here. So let's say this is the current market price, CMP. All right, this is the current market price, CMP. All right. Now, we are saying that we don't want to buy these assets at current market price. Of course, that will be market execution. So we're saying until the price gets to this particular level, then we want to buy that particular asset. So in that case, where we place the our entry price, that is the price we want to buy a particular asset above the current market price. All right, that type of order is called the buy stop what order. Now, in like manner, we have the sell stop order. Now, the sell stop order is simply a deferred selling order placed below the current what market price. It is placed below the current market price. If the price falls to the other level, then it will be executed. So let's say this is the current market price here. All right. This is the current market price for this particular asset. All right. But we don't want to sell these assets at this current market price. We don't want to sell this asset at this current market price. We want to sell the assets at a later price, at a deferred selling price. All right. So the price level is placed below this current market price because we still expect that the market will keep depreciating, the market will keep coming down. All right. So we place our entry price level here below the current market price. Now, once the market keeps moving and gets to this price level, automatically it will be executed, and then my sell order will be executed, and my trade will be open automatically. So this is a sell stop order. This is a buy stop order. Buy stop, it's buying. We don't want to buy at the current market price, so it keeps buying. When it gets our price level, it stops, carries us, and continues. All right, it is selling. It gets to, this is the current market price, but we don't want to sell at this point, so we place a later price. As it keeps selling, it gets to our price level, it stops, it picks us up and continue to what? Continue to sell. Now let me quickly also buttress the fact of take profit and stop loss. All right, here as well, take profit and what? Stop loss. Let me also buttress it here. Now remember, for this buy stop order, where it's still a buying order. All right, so if this is a price level we want to enter the market, of course, if the market activates here, we are expecting that as it keeps going up, we will be having profits. All right, we only make profit as prices what appreciate the level we enter the market. So this is very simple. What we do is we place what? Our take profit level. This is our entry price. Remember, this is our entry price, EP. Pardon me. This is our entry price. This is our entry price, EP. All right, beautiful. Now we are expecting prices to appreciate more than our entry price. This is the point we enter the market, and so we are expecting that if prices should move to a price higher than the price that we enter the market, then we are going to do a take profit. That is where the take profit order comes in. All right, that is where the take profit order comes in, and then we have um this take profit order. So we call the take profit order TP. All right, now beautiful. Now we're not done yet now. Remember, this is where we enter the market. We're expecting as prices appreciate because we're buying. It gets to a take profit level, we take profits. But consider it that what if prices comes from the from the current market price, prices moves and then triggers your order at the entry price, and then it fails to get to your take profit level, but begins to what? Go against your analysis. All right. For instance, your analysis were invalidated. What happens? If you were not there, you probably may come back and you notice that you've lost the whole of your capital. So that is why we have what we call the what? The stop loss order. Right? The stop loss order is placed below your entry price, all right, well calculated to risk or expose certain amount or certain percentage of your account. All right. So let's assume that it's placed somewhere. I like for sake of learning, let's just choose anywhere. Let's assume below the entry price. No, let's not use there. Okay, pardon me. Okay. Okay, let's say it is placed somewhere here. All right. So this is going to be our stop loss, SL. All right. Now, notice the symbols. CMP is current market price, SL is stop loss, EP is entry price, TP is what? Take profit. Now, because it's a buying order, the market comes, picks us up here at the entry price, and then the further it goes, we make profit, we take profits here. All right. So our take profit order will be placed here, and then above the entry price, and then our stop loss is below the entry price to shield us, to guard us, all right, from huge losses. All right. Now the same thing happens to the sell stop order. Remember, if you say sell stop, it's a sell order. All right. So if the market picks you up here at EP, you're expecting that the market, as it continues to depreciate, you make what? Profits. All right. And then if it picks you up here and begins to go up, begins to appreciate, then it simply means that your analysis were what? Invalidated. So what happens? We have the stop loss to shield you from huge losses. So in a sell um in a sell order, we have this trade setup. Here is what we call the EP, right? And then here we have the SL, and here we have the TP. All right. So I just had to do this to make you better understand trade setups. All right. For you to better understand trade setups. Okay. Now watch. This is a sell order. Remember, we said if you say sell, what your broker understands is that prices are going to depreciate. Prices are going to keep going down and down and down. All right. So if you are taking the order at this level, which is your entry price, if the market continues to go below your entry price, you're making what? Profits. The farther and farther it depreciates below your entry price, you make what? Profit. But should the market appreciate, begin to appreciate, and then it gets to your enterprise, and above your enterprise you're making losses, right? Above this enterprise you're making losses, so you need your stop loss above your enterprise to shield you from what? Huge losses. And then your take profit below your enterprise, so that should, in case you're not there, the market can be closed for you with the calculated profit that you want to take out of the market. So this is the trade setup and how it looks like. All right, don't make mistake. Take profit is above enterprise in buy orders, and then stop loss below the enterprise, and this is buy stop and sell stop. All right, for sake of time, let's quickly move to explaining um some more concepts. All right, so we have next the buy limit orders and the sell limit orders. Please follow me keenly, just follow me. You have the buy limit orders and the sell limit orders. Now, the buy limit orders is also a deferred buying order. This time around, it is placed below the current market price. All right. Remember, in the buy stop order, the entry price is placed above the current market price. But in this case, for buy limit, it is placed below the current market price. And I'll explain that. Just follow me. If the price falls to the limit order level, then the buying order will be executed. All right. So for that of buy stop, we said that the asset is buying, the asset is appreciating, like we explained, it is appreciating, and then you said it should get to this point, it should carry you. So it stops and carries you and continues to go up, right? Beautiful. But in buy limits, it is not so in buy limits. So in buy limits, you have actually noticed that okay, whenever probably the market gets to this particular level, whenever the market gets to, just giving you an instance now. Beautiful. So you notice that whenever the market gets to this particular level, what happens is that it bounces off, it goes up, it buys. All right. So beautiful. Now the market is actually coming down again to this level. What you do is simple. All right. You place an entry price around this level that you're expecting the market to what? Bounce off. All right. So this is the current market price here. All right. This is the current market price here. That is where currently the market is. But this is your entry price. This is when you want to enter the market. All right. So let me start by labeling them. This is your current market price, right? And let's say this is the price you want to enter the market. That's the entry price, right? Now, beautiful. This is still a buying order. Don't forget. So it simply means that if the market depreciates from current market price and gets to entry price, your order will be activated. And then as it continues to go up, you will be making profit. It simply means that our take profit level should be above our entry price level. So it could be anywhere around here. Let's say somewhere around here, and then our stop loss should be below this entry price to shield us from what? From huge losses. All right? To shield us from huge losses. Okay? I'm coming. Okay. So this is our current market price. This is our take profit. And this is going to be our stop loss. All right. So beautiful trade setup. Beautiful, beautiful trade setup. All right. So this is the current market price. We're expecting price drops to this level. It picks us up here, and then as it continues to go up, we have our take profits to get out of the market on profit. Or should it pick us up here and still continue to go down, breaking this particular level we expected the market was going to bounce off, we have our stop loss to protect us from the huge losses that is going to actually what cause. All right. The same thing happens for the sell limit orders. It is a deferred selling order that is placed above the current market price, above the current market price. If the price rises to the limit order level, then the sell order will be worth executed. It is a deferred selling order placed above the current market price. If the price rises to the limit order level, then the sell order will be what? It will be activated. All right, so this is what we simply mean. All right, the same thing that we talked about here. We notice the market bounces off at this particular level. All right, so right now it is buying, it is pushing up. All right, but we are expecting that if it gets to this level, it's going to bounce below. All right, it's going to bounce and depreciate. So what we do is we have our entry price here, right? We have our entry price here, all right, and then we are expecting, okay, the market gets here, it bounce below. All right, so this is the current market price. All right, and this is where we want to take profits. And then should the market break through this level, we should have a protective level. Okay, so so um this is our stop loss, this is our current market price, and this is take profits. All right, it's still the same trade setup that we have been considering. The market is pushing up, or we want to sell. We expect that the market at this price bounces below, so we place our entry price forwards for sell. So the more it keeps selling, all right, the more it keeps depreciating, we have our take profit here. And then should it break through this level and continue to go up, all right, of course we said that it is going to sell depreciate. So if it picks us up here and continue to appreciate, then we will be in loss. That's why we have the stop loss to protect us from huge what losses. All right, you're confused about anything, please do well to reach out to me with your questions, okay, so we can finish up this. All right, let's quickly look at support and resistance. Support and resistance, we're almost done. We're almost done. This is the last thing we're considering, support and resistance. All right, now supports and market zones or areas where expected downtrends pause and reverse to move what? Upwards. Supports and market zones or areas where expected downtrends pause and reverse to move upwards. While resistance and market zones or areas where expected uptrends pause and reverse to move downwards. All right, so let's quickly look at these on this chart now. All right, we said supports are those market zones or market areas. For instance, prices were moving in this manner, right? But we notice that whenever it gets to this particular price level, this price level stops the downward movement of prices and helps it to do what? Bounce off, to move in upward direction. So it tested it here once, it moved up, all right? It tested it here once, it moved up, it tested it again here, it moved up, tested it again here, it moved up. So we can say that this particular price area or price zone is called what? A support. Why? Because it aids the upward movement, and it stops the downward movement and aids upward movement. All right. Then we also notice that particularly this particular price level here, all right, this zone here is acting as a resistance. What do I mean by resistance? Resistance are market zones or areas where expected uptrends pause and reverse to move downwards. All right, so upward trend pauses here and then begins to reverse. All right, so once we have this kind of zone, all right, we say that's a resistance. All right, beautiful. If this price should be able to break this resistance can now begin to form a new support, just like we have here. This resistance can now become a support. So this price breaks through it, test another resistant level or test another resistance zone and falls back to this resistance, but it becomes what? A support at this point. So support and resistance, easily identified by traders, helps traders to know when to take trades. It helps traders to understand when to enter the market for buy or when to enter the market for sell or when to even take profits. And we will come to that. A simple strategy that is built around the support and resistance. Having known that support hates bullish movement, resistance hates bearish movement, right? All right. So having known this, if you can find proper support and proper resistance, good support and good resistance, then a simple strategy can be to buy at the support, sell at resistance, buy at the support, sell at resistance. Why do we buy at support? If we buy at this price level, which is this price support here, we know that prices will do what? Appreciate, right? Beautiful. So we buy at this point so that prices can appreciate for us to make profits, right? And then we sell at resistance so that prices can depreciate for us to make profit. So buy at support, sell at resistance. Traders can use other techniques to validate these trade setups. All right. You can use other techniques which you're going to learn in the intermediate and also in the advanced classes and also in my special webinars. All right. You learn so many other techniques that you can employ to better identify and validate the buy and resistance that you find at these support and resistance zones. Now, note that precautionary measures should be taken by traders while buying near the support and selling near the resistance. Why is that? Because if price breaks the support and resistance zones, the trend will most likely continue to reach the next support or the next resistance. So precautionary measures should be taken when you want to buy near a support. All right. Why? Because if you say buy at this support and then this price is able to break this support and continue to go down, it will go down and go and test the next support, which is far below this support. It simply means that you're making huge loss. Why? Because you bought at this level, you're expecting that the prices will appreciate. That's why you bought. But then now it is depreciating instead. So you make what? Huge losses. So precautionary measures should be taken by traders while buying near support and selling near um, the resistance zones. All right, so we've come to the end of the beginners course. Um, Thank you so much for your time. I hope you got value, and um, please channel all your questions to me. I'll be so glad and so excited. I'll be super, super, super excited to have your questions, to mentor you, to provide answers to everything that you are finding difficult. All right. Send me your questions. Thank you so much. Thank you for your time. See you in the intermediate courses. Bye for now.